Hello and welcome to Fiddy Bounce. I will be going over the Fiddy Bounce strategy and how to use it. We will start with the TradingView chart with the 8, 13, and 9 MACD settings and the 55 and 144 EMA with a potential SMA 21. The Stoke is 512 with 5K length, 1 smoothing, 2 desmoothing, 80-20 Stoke setting. The core 3, divergence, reject a line, signal. What you do is you look for when price is near the 55 or EMA. So say we're on the charts here, wait for price to come near the 55 EMA. You see divergence with higher highs from recent highs to recent highs on the MACD histogram, and we can see that it is diverging. So the bearish engulfing pattern is our signal. We can see clearly it goes to and away from the pink line. Even here with this wick, it's a rejection. If this turned into a bearish engulfing, that would have been the sell, but it didn't. Here was the bearish engulfing. We have multiple signals, but this is it. Add a hole, simple as that. Sell. Profit. The stop loss is 2 spreads above the high, in this case the high of this wick, above the high of the candlestick pattern. So the past 2 candles generally, and bop right there. TP generally can be a past structure or 2R, or look for a reversal signal, such as you can see from here, lower lows on the momentum compared to here, and then price, like the same area to here, it's going up, whereas this is going down, divergence. So we could look to take profit around here, and it eventually does go up higher. So divergence, let's start. If you don't know anything I just said, that's fine. I'll actually teach you now. What is divergence? The first step in the strategy. Generally, the market is going to be making higher highs, if obviously, or lower lows in a downtrend, higher highs in an uptrend. If that's the case, the MACD, in my case, you can use any oscillator such as an RSI, CCI, and whatnot, but this one is what I use. It should be also making higher highs if price is making higher highs. If price is making lower lows, the oscillator should also be making lower lows. If they are not, that means price and the oscillator are diverging from each other, and that is why it's called divergence. Also, it's different. You can see price is making lower lows. The oscillator is not making lower lows, therefore it is diverging. Convergence is what it's called when they're both doing the same thing. If this MACD peak here, or trough rather, is lower here, then it would be convergence, and that kind of means it's converging, it's going the same, so it'll keep doing the same, i.e. keep making lower lows. So divergence suggests that there might be a reversal. In this case, that's what happened. So the second step, reject a line. This is what I call the Fiddy Bounce, and where the Fiddy Bounce name comes from. So imagine this. You knew that price was going to reverse here and here because you had a random line there. It's not some random line. It's a Fibonacci sequence number, the 55 EMA. It is very powerful because a lot of the time price likes to pull back to that line, and that's where it'll keep going for a continuation. Or it'll break and retest it to keep going lower. Those are the first rejection of a lines we can look to take, are when price made an expansive move outside and it's in an uptrend. Generally, you can find an uptrend or downtrend by whether prices or the pink line is below or above the purple line. Downtrend is when the pink is below the purple because it's more reactive, more faster. And then once it crosses up above the purple line, that kind of means the trend's kind of more going in an upwards direction. So generally you'd want to take, obviously, trend trades. So look for buys here. Look for buys here. But if it breaks and retests it, you can look for sells. Anyways, I'm going to just cover this cookie cutter trade. This is the bread and butter of the Fiddy Bounce. So the rejections can come in multiple signals. Here it's an MES. Rejects here. Here it rejected with an LL or a piercing or a harami. Here it was a bullish engulfing. Also a super delo. This is this 4 candle pattern. Bullish engulfing. Bullish engulfing. Bullish engulfing. See, it rejects both these EMAs here. That's what would happen if price was going to go up, and see how these lines start getting closer and closer, and then they're about to twist. They're getting closer and closer, and price broke and retest it to go up, and now they twist, and now it's the start of a new uptrend, pretty much. If just going off the technical EMAs, these are very nice trades to take right when they're twisting. It's moving on. So generally I use 3 candlestick patterns. The bullish engulfing is going to be the one that you see the most often, and it's got certain characteristics you can read here. I'm just going to skim over them. You can obviously download this document in the details, the summary section of the video. I will provide you with the download. And the second pattern, arguably the strongest pattern, is a MES, morning/evening star. Morning star is the bullish, evening star is the bearish. So if this was an up candle and then the star up top and down, obviously that's bearish. Whereas if this was an up candle with an engulfing down, that's the bearish version. Same with this one, up and then a small. So this is called LL because it kind of looks like an L, right? Generally, it could also only close like down here, like a third of the way. That's kind of a general rule. I want to see it close a third of the way, but that will be determined with the Stoke cross. Moving on. So what do I mean by that will be determined with the Stoke cross? Well, here we see an L, right? It's kind of one of these LLs, also known as piercing or harami. Sometimes they have different characteristics, but it's kind of known as all 3, this general pattern. There are 3 other patterns that are basically just a continuation of an LL. It'll be a confirmation candle, and that turns it into a 3 inside up pattern, or 3 outside up if it turns into a bullish engulfing with another confirmation, then it's outside up. Anyways, the stochastic. So we get the LL reversal here. On the close of this pattern, we got right here the Stoke to close. If this didn't close here because it didn't push down enough, it only closed like a bit up, a bit higher up, and it didn't cross, I consider it not strong enough for you to want to enter because it didn't get the Stoke cross. Part of this whole strategy was formed because I was looking at where these Stoke crosses were happening, and I noticed they would happen so much of the time near the pink or purple line with a candlestick pattern, and I'm like, dude, I need to just trade this. This is this entire strategy. You can trade without Stoke crosses if you have proper structure in your favor, but single rejections like V tops, V bottoms, you have to have the Stoke cross. So that's a sell example. Here's a buy example. You want to cross up from the 20, cross down from the 80 to sell. You're overbought. Overbought. Think of what that means. Overbought. There's too many buyers. So generally, well, now think of it like this. If you have premium and discount, are you going to want to buy something when it's on discount or premium? Discount, because that's how an array can work. I learned this from ICT, but let's just pretend that we're just looking at the 50% fib of this range. Right from the 50% is kind of equilibrium. Discount is when it's on the cheap side, the 50. If it's come back below 50, it's on discount. I shouldn't even be getting into this, but basically we want to be buying rather on a pullback, not at the top of an uptrend, as this would have been more recently. You don't want to buy here. You want to sell. You want to look for we're looking for the reversal because it's the ebb and flow of the market. That's also the theory behind this strategy, which is why I got off on that tangent, is you want to be buying near the bottom of pullbacks in an uptrend. And that is what this strategy is very good at doing. So, pullback in an uptrend, we see it near the pink line with a Stoke cross, ideally, obviously with divergence. Buy. Buy here. Buy here. So, that's a very nice fib leg up or W up. Stop loss placement. Where do we put our stop loss? Because we know now how to buy. These are our signals with the Stoke cross. Now, what is the stop loss? I went over it before, but I do spread times 2 below the low. Generally on indices, you can see how this was a NOS chart. If you do Forex, I do spread times 1. So that's the calculation I do. And then you can get really small stop losses here because this candle is only a few pips, and then you only add 1.6 pips, 6.5. You know how many times you guys have seen NOS 100? How many times does it run 80 pips? A lot. So that's not very much on NOS. Standard take profits. Where do we set our take profit? 2R. But look, what if you took this and you took your profit right here around 2R? You would have lost all this. So a good thing is to look for exit signals or trailing stops. Exit signals include candlestick patterns against you, break of structure candle, closing over the 55 or 144 EMA or the 21 EMA. I'll add that in. And the chart patterns against you. And divergence. These kind of all signal to you to get out. Getting out is definitely an art and very psychological on how many of these you're going to want to see before you get out. Some people will just see one reason to get out and just get out right away. Let's look on this. So right here, this pullback, look, we got a LL and then another confirmation candle. So that turns into a 3 inside down. It wicked down, it kept pushing down more. A lot of people would have probably wanted to sell here. Right? But if you look at the bigger picture from here to here, it didn't go below like the 50%, 60% fib. Like if you had the, if I had the 21 SMA here, it wouldn't have closed below it. And that's one of the things that I've noticed a lot of the time it'll pull back to a lot is the 21 EMA. I'll write it in here. That could have been the best way to stay in here. You need to test that for yourself. Moving on to this section, you can read this because it's very much an art, and even though I'm telling you do this and this and this, you're going to have to apply it to your own psychology. So a break of structure candle obviously is, this is the past low, it's a low, it's a low. So it's making higher lows here, higher low, higher low, higher low. Made a lower low here, so this is the break of structure candle. That's what that means. Candlestick patterns against you obviously is like the bullish engulfing, the MES, 3 inside down, that not, whatnot. And divergence. But there may or may not have been divergence here. Who knows? Looking at support or resistance lines is a good place to look for a potential exit to confirm that that is the place to get out. Look, there's a high here. I should have shown more of this chart, but maybe that was a reason to get out. But it pushed up. You'll always be battling yourself, saying, oh, I should have done this, should have done that. Just have to test, because at a very minimum, a 2R here, you really can't be too mad with that, even if you just do that, right? You could do that one a day, and in a year, you're going to be quite happy. It's standard because that's what you should get used to as a new trader first, is just get used to taking those profits and paying yourself. heard that a lot from multiple people. See exactly what I'm saying. 1 to 2R, you could have took it in 2 minutes. 2 minutes, 1 to 2R. You're super happy with that. But it just shot up without making another lower low or anything. This happens a lot. A lot of time, just your first lower low. One of my favorite educators, actually my favorite educator that I've learned trading from, that's the main exit he kind of uses, is the first break of structure, the first lower low in an uptrend. Right there, you'd come out. Take what you've heard, put it in the charts and back test it. So let's see here. I pulled this one chart up. I went to a random point in time. Let's see if we see a Fiddy Bounce. I went to like 6:30 and I went till now. We'll keep going a little bit. We're waiting for the Fiddy Bounce, right? Let's wrap it all together again. What a typical trade for looks like. We look for when price is near the 55 or 144 EMA. There are multiple other EMAs that you use, like the higher value ones, like the 3 minute 55 and 144, and the 5 minute and 15, even the 2 minute and 10 minute. It's just crazy. So you want to just start with the 1 minute. I actually didn't write that in here. I probably should have done that, but the 1 minute chart is what we use as scalpers. It's very trend following strategy. We're looking, price is in an uptrend. Okay, let's wait. Oh, it's near. It touched it. It's rejecting it. What does the next candle do? Bullish engulf. Oh, that looks nice. Look at that. Let's delete this fib here. So let's look at this here. Do we want to buy here? We got a rejection of the line. The bullish engulfing. It's diverging. Let's go from this low to here. There's a link on the document that'll help you more on learning divergence. Right on clicking here, it'll bring you baby pips on divergence. It'll help you spotting that. And what do we have? A signal, buy signal, because all three line up. Divergence, rejecting a line with a signal. The Stoke cross is very clear. Let's put a buy in. I don't know, let's go to first lower low. Let's see what that is. Lower low. So 2-1. Wait, no, my bad. Okay. Next candle. Oh, we're in profit. Oh, we're in profit. Oh, let's go. Okay, we're at structure. Do we want to take profit? Take profit. Look, higher highs on the MACD, but it's kind of even here. It potentially could push it down because of that bearish divergence. See, maybe potential if got out there. What would that have been? Almost a 2R. Whereas if you just took there, knowing that there was bearish divergence, and you were at structure, does it keep going? Does it keep going? Oh, yes. So, theoretically, this wasn't the best entry. The first lower low or this. A lot of the time, it will just trickle about and keep going. So having that 21 SMA that I was saying right here on your chart can help you with that closing over. Held. You could have took partials here and then hold the rest. If it goes down, it's a win because you took money here. If it goes up, it's a win-win because you would have still had a position in and made extra money. So that's why taking partials is a win-win, and then just hold the rest. Let the rest go to your next point of exit, and hopefully it'll go up in more profit. Anyways, What happened to this trade? Nice W, I mean. Divergence from this point, lower with equal or higher. This one. Now is this a rejection of a line? Sometimes it'll go and just push away. Sometimes it will just go like this time, and you would have been happy with that entry. Look at the Stoke cross is what I say. Just take the ones that are at the Stoke cross near the line, and always take the second trade here. Imagine if this wicked down a little bit more and you got stop lossed out. You want to go for the second leg of the W, the good entry. Anyways, this is supposed to be a short, and it's 20 minutes. It's a mid-sized session. I hope you enjoyed it. Hope you learned something, and look out for the next video. Thanks. Bye.